Good morning, everyone, and welcome to the second in this IMAP webinar series on how's it going in 2023. This is our opportunity to review how markets have performed in the last 6 months, where we are now, and to share the insights into how they might perform over the next 6 to 12 months. On Monday, we looked at equity markets, and today we're looking at fixed income assets and the more complex parts of financial services markets. But before I hand over to Brad Creighton, our moderator for the week, let me just say a little about the work that IMAP is doing in our upcoming events. So we're currently engaged in a high net worth study because this part of the market is becoming central to the way advice is conceived and delivered. It's, if you like, the traditional advice market. Last week, we ran a webinar series, and that's available through our YouTube channel. We're in the process of preparing a white paper to represent our discussions with a dozen or so organizations of different types, brokers, trustee companies, advice businesses, who focus on this part of the market. And then in July, we'll be inviting a number of the participants in that study to take part in a masterclass to talk about how they attack this market. So that'll be part of our Advice in Action conference series, Melbourne, Sydney and Brisbane. And I just want to remind you of our upcoming Independent Thought Conference. So these are the topics that we'll be looking at Advice in Action. Advice in Action, we found advisors find it difficult to take a full day out of the office. So the conference is breakfast to lunch. And here are the topics which we'll be covering through that day, through that half-day session. The general theme for Advice in Action is sustainable business models for advice. As we find ourselves in a post-Royal Commission quality of advice review world, the issue of what it is that advice businesses will do that creates ongoing sustainable businesses, not just income generators, but sustainable business models, is becoming probably the key issue that advisors have to consider. And we'll be addressing those in a number of respects, as you can see. On Friday, our last webinar in this series, we'll look at physical assets and listed infrastructure, and we'll be joined by Mary Power from Jana, who'll be focused on the physical assets, real estate part of the market, and Shane Hurst from Clearbridge, who'll be focused on listed infrastructure, global listed infrastructure. Of course, I don't need to tell you how to ask a question, but I would encourage you to ask those questions. Today's session really covers some fascinating material, and I'd encourage you to take part in it. So now it's over to Brad Creighton to introduce our speakers for today's session. Brad, thank you very much.
Thank you, Toby. Hi, everyone. I'm proud to be representing AMP and the North platform as your moderator today. For those of you who didn't catch Monday's equity session, we heard from Monique Kotecha from InSync Funds Management and Hamish Tadgell from SG Hiscock. It was a very insightful session. I think the key takeaway was encapsulated by a quote from Monique, who said, "So long as equity investors continue to focus on the macro picture, there will always be opportunities in individual stocks." Both Monique and Hamish outlined their approaches to equity investing, which relied upon longer-term secular themes or megatrends. Inflation was discussed. However, it was just one of several megatrends that may underpin an investment decision. In fixed income, macroeconomics and inflation are central to the investment process, with the exception perhaps of private credit. And we have two outstanding presenters with us today to explore them in greater detail. We have Alex Cousley, an investment strategist with Russell Investments. He's been with them for 5 of his 7-year career thus far. He holds a CFA. He was a researcher at Oxford Economics Australia, and he holds a bachelor's degree in commerce and economics with honours. We also have Jonathon Costello. Jonathon is a client service executive with Western Asset. Over his 14-year career, he's enjoyed experience as an analyst, investment specialist, and portfolio manager at firms including Walsh Bay Partners, Australian Unity, JB Weir, K2 Asset Management, and Standard & Poor's. He goes by the name Jono, so I'll refer to him as Jono henceforth. Gentlemen, welcome to you both. Alex and Jono will each be giving a 10-minute presentation that will then be followed by Q&A. Now, before I throw to our first presenter, I'd like to share some analysis to contextualize today's session. I constructed a hypothetical 70-30 growth offensive portfolio comprised of Australian and global equities and government bonds going back 30 years. 2022 was the 3rd worst year for the portfolio, and that included the single worst year for the fixed income portion of the portfolio, which recorded a loss of just over 3%. Now, while equity markets have recovered strongly in 2023, fixed income has recorded only modest gains. With that said, a number of positives have emerged. Government bond yields have risen back to levels not seen since prior to the GFC. They look increasingly attractive versus other asset classes. The difference between the 10-year Treasury yield and the S&P 500 earnings yield is at its narrowest margin since prior to the GFC. Recessionary environments tend to boost the appeal of defensive assets. A combination of macroeconomic and idiosyncratic factors in America are seeing banks pull back on lending, creating opportunities in private credit markets. And divergences in how individual countries experience inflation can present opportunities for active managers in both government bonds and credit. Lastly, at yields of around 4% in Australia and the US, the portfolio hedging utility of bonds is greatly improved versus recent years. Let's unpack this further. Jono, I'll now hand over to you.
Thanks very much for the intro, and thanks for having me on today. I'll just bring up my slides here, make sure they're coming up okay. As a representative of Western Asset, I fall under the Franklin Templeton banner, and we're managing $2.1 trillion in assets under management. And that includes Western Asset, which is around 600 billion in assets under management. So as a fixed income specialist dedicated to active management, we all know just as well as any how tough a year it was, as has been mentioned just now in 2022. Now, the positive signs coming through are that those correlation benefits and yields and those defensive properties of fixed income have returned. But if we look at index history for context and look back at times past, and people talk about 1994 as a very difficult year in fixed income and 1995 being a reversal of that, we have taken some encouragement from that with a very, very difficult year that was experienced in 2022. Now, how are we going so far this year? It's been volatile and we haven't quite seen the rebound that some had been expecting throughout the year, but we are seeing some signs that it will start to play out through the course of the rest of the year as we were expecting, and we'll get that nice rebound and those mean reverting qualities within the asset class will come through, and that red squiggly line there will start to move upward. In 2022, we had a very, very difficult year as a result of the unwind of that policy experimentation, which was unprecedented. And inflation was moving in one direction. We had those supply chain issues exacerbating inflation issues, and correlations broke down. Correlation benefits broke down and moved closer to 1 across asset classes. So it was definitely a tough year across all asset classes, and including fixed income shown by this chart. Pleasingly, however, this year it's turned into a two-way conversation in terms of inflation versus growth, and that's what's driven a lot of the volatility for the first part of this year. But we are seeing some strong signs of the disinflationary process starting to get underway. These inflationary moderation circumstances are uneven, and those long and variable lags that central bankers are talking about are definitely playing through economies at varied rates, and with meaningful differences across central banks in terms of inflation. It is a very, very difficult period for them to manage how far to hike rates without detracting too much from growth. So over tightening is a meaningful risk for central bankers. And it is one that they are trying to grapple with, trying to get inflation down, but we are seeing inflation starting to moderate, which is a clear positive. Just focusing on Australia for a moment, we've got a chart here of Australian yields, and you can see with the blue line there, cash rates were led higher by the yields of the 10-year and the 3-year in this chart over the past year in particular. But they have found a point where market expectations are that we are nearing the top of the policy rate hiking cycle in Australia, and cash rates are reaching a level that is sufficiently restrictive. That is a positive, because historically, when you're looking at points where you are at the end of the policy rate hiking cycle, investors in fixed income have historically done very, very well. When you're looking at composite yields and also the credit yields, they are at attractive levels. There's an attractive yield built in now to offset ongoing capital price volatility, which is pleasing. But they're much higher on an outright yield basis, including the spread in corporate credit, that you are seeing primary market issuance and also the secondary markets holding in at these levels, catching a bid from market participants, which is quite pleasing. When we're looking across the globe at central bank policy rates and looking at implied cash rates implied by futures, this data is at the end of May, and it has moved quite quickly, as it has done for the year, bobbing around. But the clear point here is you can see the dotted lines there with the current cash rates at the end of May across different regions. And you can see those forward rates implied by futures across those different regions. And the clear signal there is whether there's more hikes priced in or not, there's subsequent cuts thereafter. And future expected rates by market participants are lower than current cash rates. So again, if you've got some duration in your portfolio, then you should fare quite well by taking on a position now. It is difficult to time these things, but it does look like we're coming to the end of the policy rate hiking cycle, which is a good time to invest. Turning to Australia in particular, you've got implied policy rates. You can see as at just last week, implied rates out to the end of the year look like a couple more rate hikes priced in, which is interesting because there are more murmurs in the market about whether that policy rate will be overly restrictive and it's going to cause a recessionary environment. You can see on the right-hand side of the chart there, the near-term expectations of those cash rates moving up to over 4.5%. But then the expectation is if that does come to pass, that the cash rate will move a fair bit lower to try and promote growth once more. Tying into that, which is something that people have been talking about in recent days, really, or in the last week, is that Australian government yields have moved such that the 10-year is now inverted, and that's the first time since the GFC. And over in the US, this has been the case for some time, between the 2 and the 10-year, and been as far as inverted as 100 basis points. But that is historically a predictor of economic recession. Whether that's true this time, because it's been a bit different, remains to be seen. But there are definitely some concerns about an economic recession coming through. For Australia, as has been spoken about, we've got these fixed rates rolling off, and so that consumers are now moving to more of a variable rate mortgage situation. That is a positive. If it came to a restrictive policy regime being over restrictive, then the RBA would be able to ease, and then it'll flow through quite quickly into the economy. So you don't want to over tighten and cause major issues in any economy, because it's harder to restart the engine if things have broken down. But with the policy transmission mechanism being quite straightforward in Australia relative to other regions, then that's a positive. So this has thrown up quite a lot of opportunities. We are seeing a real case for fixed income as an upward allocation in strategic asset allocation frameworks. But we do want to highlight that the benchmark has changed by a huge margin over the last 10 or 15 years since the GFC. On the left-hand side of this chart, you can see that the UBS Australian Composite Bond Index, as it was then known in December 2006, was comprised of a very different sector allocation as compared to May 2023. You'll notice Commonwealth government was around 22%. It's now been it's moved much higher as that weight of Commonwealth government issuance has come to market. And similarly, the semi-governments, they've kept similar pace, but corporates, which represented 33% back in those days, are now down to around 7.6%. The key point here is when you're looking at core fixed income allocation, you do want these defensive properties, yield, and correlation benefits from the index. But we see opportunities for active management to play a great role here, where you can alter the composition of your fund to try and get a premium yield, not increasing risk by any great degree, and really take advantage of active management opportunities. Similarly, on the duration front, there's been a real opportunity with this volatility in markets to benefit from active duration management. And it's a little hard to see on this chart, but you can see that over the course of the last year, there's been a lot of market movement as a result of different market environments across the globe, inflation moderation, and then new data coming out. You've had certain market events that have shifted yields rapidly at the same time as that monetary policy hiking cycle playing through. So there are opportunities within portfolios to manage duration actively, and we're seeing that come through as additive to our portfolios. On sector allocations, real opportunities within sectors. In Australia, it is a very high quality index, and we're seeing corporate credit spreads. They've widened materially. They're not at historical wides, but in recent history, they're quite wide. And when you compare against COVID environment, you can see that we're beyond where we got through that COVID uncertainty. So spreads are fairly wide. And then on top of the yields that have increased, the outright yields available in corporate credit offer a significant buffer to increase default risk if there was any deterioration in economic growth. Down the bottom of this chart, highlighting the SSAs, sovereign, supranationals and agencies versus semi-government. There are opportunities to actively trade that part of the market as well. You can see that SSAs, or supranationals in particular, which are AAA rated assets, which compare to AAA rated government issuance, they have traded much wider relative to government and at the same credit quality. Then there's an active management opportunity to benefit there. And similarly, semi-governments, they are somewhat lower rated, but have a lower yield. So you've got an opportunity to have a higher yield with lower risk, so increase your risk-adjusted return of your portfolio through active management. On that investment grade credit piece, just a few charts here, bit complex to run through them all, but the key contention is that fundamentals are at quite attractive points. We've got sales revenue per share across ASX 200 companies. That's definitely increased. Cash flow management has been fairly conservative since COVID, and we haven't had a huge escalation in the level of net debt across the ASX, and so too the issuer base in Australia. This chart just quickly points to those spread differentials, semis versus supras, and the pale green line there versus the blue. You can see there really is a yield pickup for the supranationals, which is somewhat tied to some changes to the bank's required assets, the assets that banks were required to hold. So yeah, there's a benefit that you can have from upwardly weighting your supranational exposure within portfolios. Just nearing the end there, but just touching on that owner-occupier home loan balance and mortgage rates, which I quickly touched on previously. You can see here that owner-occupier home loan rates, home loan balances have increased materially over the last few years as those low rates were made available to them. And the bottom squiggly line in green there, you could see that fixed rates did get sub 2%, but they've now reached much higher levels and people are switching to variable, upwards of 6%. So those transmission mechanisms of monetary policy are starting to play through economies, and we are seeing a case that inflation has got to moderate. And growth will slow, but our view is that it's not going to slow to a major recession in Australia. So that'll come to the end, and I can pass over to Alex, and we can come back and have some questions afterward.
Yeah, fantastic, Jono. Look forward to the question sessions there. I'll throw to Alex.
Okay, thanks, Jono. Thanks, Brad. I'll just share my screen as well. So yeah, I mean, as I think a good intro was from Toby about, economics is a much more important part or essential part of fixed income. We were just talking, Toby and I, before the call about a book that we're both reading about the economic history, a long economic history. So I promise not to get too wonky in terms of the economics, but we are in a really interesting juncture in our view for fixed income markets. And Jono mentioned about that risk that's been presented, or that people are talking about, that central banks might have over tightened.
Alex, just to interrupt for a minute, what we're seeing is the presenter view rather than the slideshow view. So
right, something's going on. There we go.
Yeah.
Is that better?
Perfect.
Thank you. So yeah, we do think as a house that many regions around the world, or many countries, have actually over tightened, most notably in the US with the Federal Reserve. So, we have our three scenarios of where the world is going, or where the world is looking for the United States. We do this for other regions, and we think that a recession is more likely than not over the next 12 months. We don't think it's going to be a severe recession. It is quite a scary word, recession. We expect more of a mild to moderate recession. So kind of that 1 to 2% GDP down. Unemployment rate jumps up to 5.5%, 6%. That kind of more, I guess you call it run of the mill recession. A similar story can be seen in the United Kingdom. We think that their central bank has clearly gone into policy mistake territory now, following that 50 basis point hike last week. And in Europe, it's probably a little bit less than the US, but still elevated recession risk. As we get closer to Asia, though, I think that personally, I've been surprised that the RBA have kept hiking rates. I think we're seeing signs that the economy is slowing quite quickly. But I don't think that recession risk, or that over tightening, is as prevalent in Australia just yet. The yield curve has inverted, but it's still pretty temporary so far, and it's not as deep as the United States. And the yield curve is truly one of the best predictors we have of a United States recession, and typically leads by about 12 to 18 months. And so when we're thinking about the timing of the recession, that kind of puts us in about Q4 this year, or if not, first half of next year is when that, the best guess of when that would start. So we as a house do think that duration is presenting a pretty attractive opportunity, particularly in government bonds, and largely around the world, with one exception that I'll get into in Japan. And it really is around the kind of the nice diversification benefits that we have if we are right that we're entering into a more serious slowdown or recession. And secondly, that we just think that valuations look really attractive, across most regions. One of the things that we have kind of in conversations with clients and other managers that we've talked to is around this view that there is a risk that the Federal Reserve, or whoever the central bank that we're talking about, won't respond to a slowdown or a recession in the same way that we have historically, or we've become accustomed to as investors, because inflation is very sticky. And I think that this chart is really telling in terms of what we should expect from the Federal Reserve or other central banks. Typically what you've seen, and we went back to 1957 here, the recession, is that in a period of recession, the median experience is that you see 450 basis points of cuts. And for the first time in 15 years, central banks actually have the room to do 450 basis points of cuts. And the lines that I would draw your attention to are the yellow line and the dark red line that are labeled Volcker 1 and Volcker 2. So Paul Volcker was the head of the Fed in the late 70s, early 80s, famously crushed inflation, brought the economy to a pretty quick halt, brought interest rates up to 18%, and was the man that was responsible for basically bringing us back into this great moderation of inflation expectations being contained. He started cutting interest rates when inflation was running at 10%. And he cut rates very aggressively, eventually by 11%. So, even the most hawkish central banker that we have in modern history responded to a recession the same way that, economic convention would tell you that when you are seeing signs that the economy is really slowing quickly, you need to provide some sort of accommodation for them. And the second way that we come to this 450 or, around that level of interest rate cuts that are going to be required in the US, and it's a slightly lower number in Australia if we do hit a recession, is that there is this concept in economics, and it's a jargony thing, but it's very important for central banks, and it's called the natural rate of interest or the neutral rate of interest. And you can never know what it is for sure, but you can model it out. And it basically tells you the interest rate at which the central bank is neither providing gas to the economy or putting the brake on the economy. Right now, our thinking on that rate and the Federal Reserve's internal thinking is it's somewhere between, call it 2.25 and 2 3/4. And so for really to provide accommodation in the next recession, you have to get below that level to provide support to the economy. That's how the central banks will think about this. And so we do think that the market is expecting a few interest rate cuts, as Jono mentioned earlier, but if a recession starts to present itself, there is a lot more interest rate cuts that will come about. The second thing that we think is really attractive on duration and treasuries right now is that, by and large, the market still thinks the interest rates are going to rise, or if not, kind of hold steady. And we can observe this through the Commodities Futures Trading Commission. So all traders in the United States have to provide their positioning to this as a government regulatory agency. And the black line here is the summation of all the different government bond contracts that they have on offer. So from the 2-year out to the 30-year, you can see that the market is really, really short. And across each of those tenors, what we have observed through history is that when we get to these, we call them unsustainable extremes, when the market is so one-sided in their positioning, it doesn't take a great amount of a catalyst to see a reversal. And so, we are seeing that the cycle is supportive, and that if recession risk is elevated, central banks will respond and rates will move lower. And the second thing is that the market is very one-sided right now on this positioning. And so that kind of, again, just adds to that view. I mentioned Japan. So Japan has become a very interesting market after being a widowmaker trade for the last 25 years. It is one area where we don't think duration is particularly attractive. And there's a main reason for this is that Japan is in its own little world in terms of the monetary policy cycle. You can think of most countries as kind of following a similar pattern to where the United States has been or where Australia has been, and there's just different lags and leads in terms of who entered tightening first and who is going to exit tightening first. Japan is kind of been very steadily not doing anything. They made a small change to their yield curve control program, but they're finally seeing signs that inflation is actually getting to that level of sustained inflation. And the chart on the right, the orange line services, this is the inflation part that has worried every central bank that has kind of continued to raise rates. It's that wage sensitive part. It's the services side of the economy. When that becomes entrenched, that becomes the thing that you have to work really hard to bring down. They've now reached 2% services inflation. We think that over the next, call it 3-4 months, that they will continue to make changes to that yield curve control program. Firstly, because the economy is getting into a better place, and secondly, the chart on the left looks at the bond market functioning of the Bank of Japan, that the Bank of Japan do through their survey. And there are days where there is no Japanese government bonds being traded. The Bank of Japan own too many of them, and not much is happening. They want to alleviate that pressure, and so one way to do that is to kind of let that yield start to move higher. And we think probably they're going to go from 50 basis points to 100 basis points. And so it's hard to get too excited about Japanese bonds. Finally, on Australia, I think Jono and I share similar views, or our houses share similar views. And that I agree that I think Australian recession risk is lower than what we're seeing in the United States, certainly what we're seeing in the United Kingdom, or for that matter, New Zealand. We do think that Australian fixed income continues to look fairly attractive relative to the United States. We had favored the shorter end before the RBA started, kind of reverted back. Once they hit that pause, we moved across to the longer end because we started a little bit more worried that there was a more meaningful slowdown coming. We're certainly seeing signs of that. Whether the RBA have paused for now and finished, I think there's still a risk that there's one more, but I think the market expectations of two is probably a little bit aggressive unless we see a kind of rebound in the economy. One important thing to note, in terms of comparing recessions, is that one of the big kickers for Australia right now is that we have a huge immigration wave. We're talking about 2%. Increase in population. So that gives you a pretty healthy kicker in terms of that per capita. We do think a per capita recession is likely, but the immigration wave is going to support that. The last thing just to quickly touch on, I'm probably running a little bit over time, is on private credit. And so, we have a private credit fund, we have private credit manager researchers that specialize in this area, including Clive Smith, who is also our Australian fixed income portfolio manager. They're still quite upbeat on private credit. There are obviously economic headwinds across the world, but generally the exposure that we are getting through our private credit managers is fairly high quality. Some of it is also with floating rates, which is a pretty attractive opportunity over the last 12 months, given that rates have been moving higher. And it certainly seems that right now that there is still a lot of demand from our private credit managers for more capital. They've seen more and more opportunities that are coming about, partly because I think, as one of the earlier presenters mentioned, the banks are just pulling back from lending, given what is happening with the banking system in the United States and just the general tightness of money, that they're stepping in for that. So I think there's still a lot of interest and a lot of interesting opportunities that are coming through in private credit, and we're definitely taking advantage of some of those. I'll hand it back to you, Brad.
Thank you, Alex. Great presentation, and it's as Toby said, these fixed income sessions are a bit more technical, and we've really covered a lot of ground there, so I appreciate that, both of you. Members of the audience, please feel free to submit your questions using the Q&A feature, and I'll try and get to as many of them as I can. So we'll kick off. Jono, you said that investors tend to do well at the end of a rate hike cycle. How well? Do you have any guidance that you can provide with a 12-month outlook in mind?
I haven't got precise data, but yeah, if you're looking at core duration focused strategies and you're getting those capital uplifts from the interest rates starting to be cut, then you benefit there. And that ongoing yield coming through in portfolios, you do see that benefit accruing from the running yield coming on. When you're looking at credit, often the pricing for a recessionary type environment gets pretty severe towards the end of the hiking cycle. You're seeing some recessionary type valuations coming through. So yeah, bear markets in fixed income are difficult, but they do restore valuations. So there are opportunities for long-term fundamental value managers to participate and generate some attractive returns.
Thanks, Jono. And correct me if I'm wrong, but I guess all else being equal with the direction of interest rates, if they go nowhere and you're yielding 4%, then in 12 months you'll earn 4%. And if you've got a portfolio with a duration of 5 years and interest rates fall 100 basis points, you make another 5%, or you lose 5% on the high side.
Simplified. Yep. That's equal moves across the curve of those yields. That's right. You can expect that. There's a shift downward in the ongoing yield within the portfolio, commensurate with the decrease in yields. But your expectations, if you are seeing cuts come through, if you simplify it and say 100 basis points worth of cuts across the curve, then and 5 years duration, you get that extra kicker of 5%.
Yeah. Thank you. This is for both of you, please. What are your expectations for inflation over the long term?
Yeah, I can jump in first while I got the off the mute. Yeah, long-term expectations are that they will move backward towards the central bank's target band. And when you're looking at markets and derivatives pricing for inflation expectations, and over the long term, they are bobbing around 2.5% to 3%. So somewhere towards those bands. It is taking some time for inflation to moderate, and you're seeing inflation. It's not as simple as a single number. It's across different sectors. So you're seeing goods price inflation moderating quite quickly, and that's been spoken about for some time. So that's even turned from disinflationary to deflationary. And then, you're looking at other parts of the market like services definitely starting to tip over. But yeah, it has been quite sticky. And shelter is the one where, shelter inflation, there are long and variable lags tied to that part of the inflation dynamic. It is taking some time for that to come through, but we're seeing some preliminary signs of that rolling over. So, it's going to be uneven, but that does make things more volatile, but it also presents opportunities.
Thank you. Alex?
Yeah, I would tend to agree. I think the one longer term thematic that we're still kind of grappling with, I think most are grappling with, is, to what extent does the the greenflation, right, the kind of clean energy transition, what level, that investment and that money that's been thrown at that based on what governments are saying, what, amount of inflationary impulses that present to the longer term drive. We've done a bit of research on this, and I think 25 basis points on a longer term inflation is about as high as you can reasonably expect. So, we were talking about this during the coming out of the pandemic. There was a lot of excitement about 3.5%, 4% is the long term inflation norm, and we were pretty unconvinced of that. I think if you look back now, we have governments that are pulling back quite quickly on other spending. You have central banks that are raising rates very aggressively. So that back to target and maybe 10, 20 basis points higher on greenflation if that comes through. And that's a pretty reasonable assumption.
Okay, and I'll put you on the spot just to follow that up. So 25 basis points higher than the long-term average as a result of decarbonisation.
Mm-hmm.
But you've got themes like digitisation, which is deflationary, disinflationary. You've got deglobalisation, which is inflationary, as we have to onshore and produce things at a higher cost. Do you have any sense, and demographics are a disinflationary force as well, because the world's generally getting older. Do you have a net sense of whether inflation will be higher or lower when you take all those things together?
So I probably should be a bit clearer that the great, decarbonisation is the big factor, but we've kind of incorporated most of the others. The one that we don't have a great answer for yet, I don't know if anyone does yet, is AI. And that digitization is the next step above it. That kind of can make demographics very different in terms of the impact that demographics will have. So I think if it nets all out, I think it's slightly higher is a reasonable estimate, but we aren't talking 50, 100, 150 basis points higher. It's pretty minimal.
Yeah, I agree. For what it's worth, it's maybe higher in the medium term, but longer in the longer term, it'll come down once we re-onshore and costs get bedded down. Okay, this one's for quite an academic question. Milton Friedman famously remarked, "Inflation is always and everywhere a monetary phenomenon." Was he right? Alex, do you want to handle that one?
Sure, I'll have a crack at it. So he wasn't for a long time, and you could argue that COVID was a good justification for that theory. I'm not as convinced, because it wasn't just that we had big money supply. You also had these insane supply chain shortages. And then you had, it seems that the wage story is as much the tight labor market as well as some element that people are kind of reappraising what they were doing and what they enjoyed. So I think if you're a monetarist, if you're an advocate of Milton Friedman, you're certainly slamming the table right now and telling me I'm an idiot for not agreeing 100%. But there's an element of it, but I think it's a bit more complicated right now than that.
Yeah, on that one, it was an interesting question, and I did see that there was a later clarification that he was referring to episodes of persistent inflation, and that in the short run, supply shocks can impact the price level. And when you're looking at a recent paper released by Ben Bernanke in mid-June, it was just over a week ago. He definitely said that the recent bout of inflation is predominantly supply driven. And to the extent that's true, that is a positive because we've got healing supply chains, which everyone's aware of. But also on this point of money supply being at the heart of the inflation dynamic, you're seeing most recently the year-on-year change in the money supply is now negative for the first time since the Great Depression. So if it is the money supply, then there are obviously going to be those long and variable lags with expansion and contraction of balance sheets, and whether it's fed into asset prices first and then the supply shock has actually led the inflation higher. It's never going to be answered perfectly, but there's lots to unpack with that academic question, I think.
Yeah, I think money supply, if it was the be all and end all, then why has Japan had no inflation for 20 odd years, 30 years? And why did all the QE money not result in inflation? I think it's where the money ends up and it results in the hands of consumers who spend it. That's a more direct impact, isn't it? So it's more nuanced. Jono, while I have you, you made the point, you both made the point that recession risks in Australia are low or kind of more moderate relative to the US. Alex made the point that he's more concerned about the US than Australia. So can we talk about why that is? And I'm just on a one-dimensional sense, housing. In the US, they have 30-year fixed rate mortgages. So a lot of people locked in much, much lower rates than what we see in the cash rate today. So theoretically, they're in a better space than Australian homeowners who have variable mortgages in a higher portion, and that should be crimping their spending a lot more than the US consumer. So how do you reconcile that and see Australia as being in a better position?
A few different ways to tackle that. Firstly, when you're looking at the Australian economy and ties to other regions, we do benefit from those commodity price increases, and same with agriculture being a net exporter. We're definitely benefiting from our net exports, and that's put our balance sheet in a better position than it would have been otherwise since COVID. So we are benefiting from ongoing export. So that's holding us up nicely. We do have also more people coming to the country, which is supportive of GDP. So that's a benefit. And then opening of the supply chains again, and China abandoning that COVID zero policy is a net positive. On the transmission mechanism, I mentioned earlier, agree that it is hurting the people who are homeowners and they've got big mortgages more quickly than in the US, where they've got those longer term fixed rates. But there were some build-up of prepayments, offset accounts, but it is starting to definitely be a pain point for consumers. There are sections of the economy that they're in a pretty healthy position when it comes to mortgages, but you're definitely seeing those pain points. But with those fixed rates rolling off, you're starting to see that pain come through. But if there is an economic growth contraction, the RBA is going to be conscious that the proportion of variable rate mortgages in the economy would have moved back to kind of pre-COVID highs over the next 6 months. If they do want to cut rates, it'll flow through much more quickly than the hiking cycle has been able to come through.
Yeah, thanks, John. Alex.
Yeah, I mean, I guess there's two things that I would add. So the first is the central bank, like there is a different transmission mechanism, but if you look at where that neutral rate versus where the Fed is, where call it 300 basis points above neutral, so they're really putting their foot down on the brake. In Australia, there's more wide range of where that R star or neutral rate is, but I think the latest RBA estimate is 3.8%, so they're potentially 1% above. So we aren't seeing the same huge break. The fixed rate rolling off is probably the key question for everyone right now. I think I'm encouraged, and it's still a risk, but you do have a huge amount of people that have built up huge stockpiles. I think the RBA have 40% of households have 2 years of mortgage payments or prepayments as a buffer. So, there is going to be a vulnerable part of the household sector, but I think there's also quite a large amount that are actually been kind of prepared for rates to move higher. and kind of well positioned. So it's going to be slowing, but I think that kind of gives you that US versus Australia dynamic.
Yeah, thanks. I think what's also overlooked is when you work from home, your discretionary spend is a lot lower, and that tips into your mortgage, and so overall you're not in as bad shape as the headline numbers might suggest. And probably we don't understand the overall impact of that because it's something we've never seen before. Alex, you mentioned that in the US, historically, the central bank, the Federal Reserve, has tended to cut by around 450 basis points following the peak of a business cycle. So let's say we cut 450 basis points and we're back at the zero lower bound. It will have been a great journey for those holding bonds, but once you're there, what then do you do as a fixed income investor?
It's a great question. So I think you probably move, well, provided that it's effective in getting back to the zero lower bound and that we can actually get a recovery generated from that. I think that's where you start adding in credit risk and you start moving away. The standard early cycle dynamics should play through. Whether we actually hit the zero lower bound, so that 450 is kind of a normal range. We'll get close to it though, and I think what you should just do and what fixed income investors will see is just credit spreads will start to tighten. People will be willing to take on more risk. Within multi-asset portfolios, I'm sure you'll see people move from fixed income across to equities, in those balanced portfolios. So I think that's what you'll generally see is that you kind of, move away from the safer part of fixed income and take on a bit more risk, given that you're early cycle.
Yeah, Jono.
Yeah, it's to echo that. It's just sector rotations back in play, and you can take on a bit more risk. Just tying into some of the comments that Alex made earlier, with Japan being an interesting case. They've had to grapple with not a lot of inflation and it's starting to come through. You said, not overly exciting to hold Japanese government bonds, but for active investors, you can go underweight certain regions, and we're seeing that as a bit of a free option. There's been reiterated commitment to that yield curve control policy, but if that band is widened somewhat, then it's a bit of a free kick when it comes to portfolio. So active rotation across sectors and regions, it's important. And when rates are low, then you got to try and get your return across that active rotation in your portfolio.
Yep. Does decoupling from China result in higher inflation over the long term?
It's a good question. I think it's probably very similar to what we were talking about earlier about deglobalization in general. In the shorter term or the medium term, if this decoupling happens to the extent that some are worried about, it certainly will lead to a slightly higher inflation impulse. That will be offset by lower demand, right? As prices rise, unless you have a solid wage growth coming through in developed markets, it's slower. It will be a slower demand impulse. And the other thing is that the reality is that most developed economies can't compete with China in terms of labor costs. And so whatever decoupling comes about will likely lead to a lot of investment in terms of automation and various robotics and those sorts of things to try and bring those costs down. So, it'd probably be a shape where medium term might be a little bit higher and then longer term kind of back down to where we're talking about as we were talking about earlier. I mean, the one thing I would just note is like the decoupling from China. There are definitely parts of the economy that are going to decouple and have to be. I think COVID was a great example to show that you shouldn't have medical supplies or built or produced in one country. That said, some of the electronics and consumer goods, the Asian supply chain is extremely tightly knit. And so, I think there is going to be a bit of hesitancy to move out of China into, the West. It's going to be moving out of China and moving to places like Vietnam, perhaps Indonesia, various countries like that, which we have started to see already. And so, that was an even flatter inflation profile.
Yep.
For me, that was a great answer to that question from Alex. But there are other considerations as well. You've seen some tariffs applied from China to other regions to try and increase the ability of their economy to grow. But with some healing of some trade relations. You're starting to see them get wound back, so that'll be a positive. But then when it comes to onshoring, or which some people talk about, there's also benefits from friendshoring. For example, like Mexico, they've got close ties to the US economy, so there are opportunities to invest in regions like Mexico, who they've got those close ties, but might help with some supply chains for the US at lower costs. So there are also opportunities from it coming through. So I agree with Alex. Yeah, in the short term, it could be inflationary, but in the long term, always going to work through and trying to find the lowest cost producer. And some people are starting to talk about India playing a bigger role in global economic growth, and that might help.
Yeah, thank you both. So I think this one is probably for you, Jono. Fixed income investing, especially active approaches, have a lot more going on than just buying. Could you talk about some of the differences, types of securities and strategies that differentiates you from a passive holding?
Yeah, there's in the Australian context, you've got different alpha drivers being duration and yield curve management, more macro focused, and sector and security selection. Then globally, you can also play currency and country allocations. But with a bit more of a return to fundamentals with the end of unconventional policies like yield curve control and QE, we're definitely seeing an opportunity to allocate more risk to duration and curve. Yields aren't being pinned down, and you haven't got these big bond buying programs. So we can trade actively around that. But as I mentioned just in the presentation, in Australia, for example, that sector allocation does present opportunities across supranationals versus semis, but also in the corporate space, you can really get a meaningful yield pickup by lending to corporates for shorter periods of time. So at the short end versus government, very high quality names that we've got very high conviction that they're going to run through to maturity. So rather than just taking whatever the benchmark gives you and they're weighted towards the most indebted, you can tailor your portfolio to try and get a better yield profile, but still maintain those defensive correlation and yield characteristics that you're seeking.
Yeah, got it. Thank you, Jono. Alex, there was some discussion about the Fed has over tightened long and variable lags. How long? When do you think that we really start to see, and kind of the bearish equity crowd has been disappointed this year by how resilient the consumer has been? When do you think we'll start to see the tighter financial conditions kicking in and hitting consumers and businesses?
The easy question, huh? Look, so the long and variable lag part, like normally it's like the yield curve lead is about 12 to 18 months, and that inverted September last year. So that puts you in Q4 this year, Q1 next year. Consumer has proven pretty resilient. We suspect that will probably shift pretty quickly. I think the real watch point in the US that we're keeping an eye on, and it's coming up, is earnings season, particularly around profit margins. Profit margins have proved pretty resilient thus far, but we know that interest costs just keep rising for most corporates, even for those corporates that got to fixed rates, they're kind of coming towards that. And it's not as big a cliff as we see in Australia, or we talk about in Australia, but that dynamic will come through. As soon as profits start to get hit in a harder way, I think that starts to see the layoffs. Unemployment rate starts to rise, and that kind of flows through. But I would think by the end of the year, we're seeing some more signs that the economy is seriously slowing in the United States.
Yep. Thanks, Alex. So, Jono, you threw up a chart of the Bloomberg Oz composite, and there's quite a difference between 2006 and today, the representation of corporates in the portfolio. Is that true in other markets in the US and in Europe? Is it still the same rough mix?
I'm not exactly sure. I have to defer to my global colleagues if I could, but just having a think about it, lots of government issuance has come through in Australia, and I don't think it'd be too different across regions where government indebtedness has got a lot worse. through GFC and then coming out of the COVID period. So yeah, a lot of fiscal moves to try and generate growth. So I think yeah, it'll be a similar story.
Yeah, thanks, Jono. And I'd hazard a guess that since the GFC, ratings criteria has probably gone up a notch, and so what was previously a AA or a AAA corporate is no longer. And so if you're trying to represent the most defensive, high quality assets, then it's probably why it's your govies and Sevi govies and supras more so than corporates. I'm getting close to the end of the questions. The last one I have here is: equity investors tend to keep a close eye on bond markets and inflation. Is the same true of fixed income investors? Do they pay any attention to what equities are doing? I'll let you both have a go at that one.
In my experience, not much. I think it's more one-way traffic. I think the fixed income investors, we do look at the fundamentals of the equity market in terms of how companies are going. It's a good insight into how the economy is going, but the day-to-day equity market moves, I don't think that there's much insight taken from them for fixed income.
Yeah, I'll probably say the same. Did find it quite interesting when you had those debt ceiling negotiations recently, and in previous negotiations, you've seen equity markets really getting whipped around, and that's been something of a motivation for Congress to try and work it through and say, hey, look, we're really causing a lot of issues, whereas this time we kind of sailed through. So yeah, that's a little bit of colour. I was just having a think about it, but yeah.
No, I don't. I shouldn't be in balance in the sense that equities, when you discount them in net present value terms back to today, you need to know a little bit about interest rates and inflation. But bond markets don't need to fold in anything about equities into their value. So that kind of makes sense. I've got one here. Are the markets underestimating the geopolitical risks around Russia and Ukraine?
Are they underestimating them? I don't think so. I mean, they did underestimate them clearly when it started. I don't think many people expected it to get to the point that it has. I think that eventually the focus will really shift to Taiwan and China. I think that's kind of I don't know if you could say that the market is underestimating, because a lot of people talk about it, but I think that's the one that kind of will probably become more important, particularly as we approach the Taiwan election next year. I think that's going to shift the market focus from Russia, Ukraine, which is kind of also just faded to the background, absent the weekend's events where there was a coup that wasn't. I think that's where the focus shifts.
Yeah,
I'd agree with that, really. So.
Yeah, I think that's fair. I think, as tragic as it is, it's a very localized issue, not a macroeconomic global issue. Unless energy costs, for whatever reason, were elevated for a long time because of what goes on in that conflict. But yeah, thank you so much, guys. That was very insightful. I got a lot out of it, and I'll throw back to Toby.
Thank you very much, Brad, Jono, and Alex. As I mentioned at the start of the session, there's always more to think about when the fixed interest guys are on, because it represents that market blend of outlook and expectations. So just a quick reminder of particularly the masterclass on high net worth. We'll be looking at issues such as serving the family office market, structuring to serve the high net worth market, managing the tension between high service and high efficiency in high net worth advice businesses, and we'll be looking at we'll have a panel discussion of whether the investment needs of high net worth investors are different from the mass market. So I'd encourage you to come along to our Advice in Action conference in July, and then if high net worth is a market that's of interest to you, to stay on for the masterclass in the afternoon. So just a quick reminder again of the advice and action topics built around a theme of building sustainable business models for advice. So thank you very much for your time today and for attending. We look forward to you joining us again on Friday. And to Brad, Alex, and Jonathan, thank you very much for today's excellent session. Look forward to talking with you again on Friday.